Ladies and gentlemen, good day and welcome to Macrotech Developers Q4 FY24 results earning conference call hosted by Antique Stock Broking. As a reminder, all participant line will be in listen-only mode and there will be an opportunity for you to ask questions once the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Biplab Debarma from Antique Stock Broking Limited. Thank you and over to you, sir.
Thank you, Ria. Good afternoon, everyone, and welcome to the Q4 FY24 earnings call of Macrotech Developers Limited, hosted by Antique Stock Broking. Today, we have with us the management of the company, represented by Mr. Abhishek Lodha, Managing Director and CEO, Mr. Sushil Kumar, CFO, Mr. Tikam Jain, CEO, Pune, and Mr. Anand Kumar, Head IR. Without further ado, let me hand over the call to Mr. Lodha. Over to you, sir.
Good afternoon, everybody. A warm welcome to the call. I hope all of you are doing well. As we end fiscal 24 and enter fiscal 25, this is now the fourth year of the sustained upcycle in Indian housing. As we have said several times in the past, we think that India is in the midst of a once-in-a-lifetime of the country's transition from low income to mid-income, which is aided by housing demand and in turn significantly enhances housing demand also. We believe that with steady wage growth, ongoing increase in economic activity, as well as the plentiful availability of mortgages, combined with India's demographics and urbanization trends, the demand for housing will only continue to scale up in the years to come. Before I get into details about the company's performance, a little bit of overview about the industry. Starting with the macro situation, the Indian economy continued to perform strongly. As per various experts, wage growth for this year is likely to be between 9 to 10%. We are seeing an acceleration in private investment which is starting to happen on account of the various policies of the government, including the PLI scheme, as well as the continued attractiveness of India for the what are known as GCCs or Global Capability Centers. While India continues to remain a beacon of strength, economic strength in the world, obviously the global situation has been full of various challenges, including geopolitical tensions. This is a risk which is pervasive and in front of our eyes, and from time to time, it is definitely likely to have impact on the overall sentiment as well as the direction of several macroeconomic indicators. However, in spite of these global risks and challenges, global growth has continued to surprise on the upside. The US continues to go from strength to strength, and that means that overall sentiment in the globe continues to remain positive, and we are seeing the US and India emerging as the two strong drivers of global growth. Now, diving a little bit further into our company's performance for fiscal 24 and our outlook for fiscal 25. Fiscal 24, our focus, as always, remained on our core 4 KPIs, our pre-sales, the embedded margins of those pre-sales, our new business added, and our brand and ESG scores. We achieved our best ever quarterly and annual pre-sales performance with Q4 sales growing impressively by 40% to about 4,200 plus crores, and we closed the year with pre-sales of 14,500 crores, which is about 20% growth from last year. In terms of pricing, in line with our guidance, we had an overall average price growth of approximately 5.5% for fiscal 24. This, we believe, is strongly supportive of affordability because wage growth definitely has been closer to the 9-10% mark, and in turn will mean that more and more Indians can continue to buy a high-quality home from top developers like Lodha. The embedded EBITDA margin for our business was at about 31%, and this 31% has been achieved this year in spite of the fact that we had a higher contribution of sales, with almost over one-third of our sales coming from JDA projects, which tend to be lower in terms of EBITDA margin. We are now close to the steady-state mix that we expect in terms of JDA contribution, and with this, since our margin has come in at about 31%, it shows that the underlying margin has actually grown, and we expect that even with the moderate price growth, due to our operational efficiency and scale-up, we will keep seeing a steady growth, a modest but steady growth in margins. Based on the embedded EBITDA of approximately 30% for the full year and 31% for the last quarter, the implied underlying PAT for our business is at about 2,500 crores, about 18% of the pre-sales done during the year. And that puts us in a good position to achieve our ROE objectives of about 20%. In terms of our business development, we added about 20,000 crores of GDV through new projects, which was higher than our guidance of 17,500 crores. Both on JDAs as well as on outright, we continue to see a steady and strong pipeline of new projects coming in. As you are aware, we have raised a meaningful amount of capital towards the end of the last fiscal in March, and that capital will become growth fuel for us, both for improvement of the bottom line as well as for strengthening our growth prospects as we invest that capital over the next 6 to 12 months. On the back, as you are aware, our net debt now stands at about 3,000 crores, taking into account the impact of this QIP, which is at less than 0.2 times of equity. If we were to exclude the impact of the QIP, our net debt would be at about 6,000 crores, which would also be, about 0.4 or less than 0.4 times of equity. Once again, well within our limit of 0.5x that we have set for ourselves. The strong management of the balance sheet and the strong performance of the business have enabled us to get a further rating upgrade. We are now rated as AA- stable by ICRA. This is the 6th rating upgrade that we've had in the last 3 years, probably a record for a corporate of our size. In terms of our average cost of funds, we are now at about 9.4%, which is down about 10 basis points during the quarter. And this was prior to the impact of the QIP and the rating upgrade, and therefore we expect to further work with our lending partners to further improve our cost of funds. In terms of our progress on the ESG side, we, by March 24, achieved our net zero goal on Scope 1 and Scope 2 emissions, which we are very proud of because we believe that for our business to sustain in the long term, we have to be a wholesome and responsible participant of the entire ecosystem, and the environment as well as society are two very, very important factors that we take into account in terms of how we measure our progress and our achievement. During this quarter, we also entered into a MOU with IIT Delhi for piloting the use of greener LC3 concrete, and another MOU with Third Derivative, a startup incubation arm of the world's leading global think tank for sustainable urbanization, RMI. And the partnership will look to foster innovation in the built environment. These partnerships exemplify our commitment to innovation and sustainability. We also announced this quarter the Women in Construction Network under our flagship Women's Empowerment Initiative, Unnati. This platform is to give greater opportunity for women in the real estate industry, which we believe, as we said earlier, is going to be a driver of India's economic growth. And if we can enable more women to participate in it, it will be good both for women empowerment as well as for the industry. In terms of certain highlights during the quarter, we did our second successful launch in Bengaluru. Both in terms of volume as well as in terms of pricing, the launches were far ahead of our underwriting, and we have now sold about 1,200 crores in just 2 quarters from 2 operating projects. This showcases the strength of brand Lodha and how well the brand is received and valued, even in a market like Bangalore, where historically we have had very little presence. In terms of where we now stand for fiscal 25, we are guiding to additional pre-sales growth of a little over 20%, with 17,500 crores of pre-sale as a pre-sales target for fiscal 25. Within this, we expect pricing to contribute 5 to 6%, volume growth in our existing locations to contribute 4 to 5%, and the balance 10% to coming from new locations. During this year, we have planned launches from sites that we've already identified and have control over of about 12,000 crores. And we, of course, expect this number to grow in the course of the year, just like it did last year. As you may recollect, last year, at the same time, we had guided to new launches of 13,000 crores, but actually we ended up achieving 18,000 crores, which showcases that in the course of the year, the launch pipeline typically tends to grow in a robust manner. With Bengaluru, now we have moved into advanced stages of our pilot phase. We've had 2 successful launches. Over the next few months, we will further assess and ensure that we have all the strengths in place to scale up our business. And we believe that that is likely to be the case, and therefore we will start scaling up our presence in a planned, conservative manner in Bangalore beyond these 2 projects. I am happy to again highlight the point that our price growth for the last year was at about 5.5%, because I think it is very, very important to note that this price growth has delivered the sales of 14,500 crores and the underlying EBITDA margin of 31%. It's very important to note that there is no speculative behavior amongst the buyers in the key markets that we are operating, because the price growth has remained modest. Equally, land prices have not done anything, odd on account of excessive price growth, because once again, the modest price growth also ensures that the growth in land prices remains modest. This, we believe, are all hallmarks of a long-term cycle, and by maintaining this discipline by us and our fellow developers, we will maximize the sales over the medium term and also equity value over the medium term. We are often asked questions around whether the level of competition is picking up now that you are into year 4 of a long-term cycle. Yes, certainly there are new players who have entered the Mumbai market, and we welcome their presence. Our market share in Mumbai is at around 10%, and the market share of the top 5 developers in Mumbai is still in the mid-20s. So there is a long, long way of consolidation to go. As more high-quality players come in, they will certainly benefit the market by taking over some of the lag or slack from the tier 3 and tier 2 developers. However, I strongly believe that the brand Lodha, the quality of our locations, the product that we build, the services that we provide a very, very significant attraction for consumers. And therefore, we believe that our journey of growing our market share in our core markets will continue to be aided by the consolidation in the market and the market having good quality players serving a majority of the supplies. So we very much welcome the presence of better quality players in the marketplace. In terms of construction and construction spend, we delivered just under 9,000 units last year. This year, for fiscal 25, we are targeting a 5-digit number of 10,000 or more units. Our construction spend last year at just about 3,700 crores was lower than what we had planned for, and therefore we are in a meaningful manner ramping up the construction spend that we are doing this year and going above 5,000 crores. As we speak, we have 20,000 or more workforce working across our different sites, and with a variety of different interventions, we are seeing that we are able to keep pace with the growing scale of our sales and ensure that we are continuing to focus on delivering our products on or before time. I would also like to highlight the fact that our growth is very granular. Now we have almost 40 different projects contributing to our sales, which gives us a lot of predictability and also does not make us dependent on any one particular location for our sales or our growth. As we further deepen the supermarket strategy of being present every 2 to 4 kilometers in the main city, in the cities that we are present in, we continue to gain sales in markets where we have historically not had presence. For example, Pune now has grown to sales of about 1,800 plus crores compared to 1,100 crores in fiscal 23 and just 400 crores at the end of fiscal 22. Similarly, for in the eastern suburbs of Mumbai, we had sales of about 2,000 crores in fiscal 24 compared to 1,200 crores at the end of fiscal 23 and virtually zero in fiscal 22. The one large location or very prominent in our long-term plans are Palava and Upper Thane, are two very large land holdings located in the Mumbai metropolitan region. Palava is located right at the doorsteps of Navi Mumbai, and similarly Upper Thane is located right adjacent to Thane. With a raft of significant infrastructure activities which have been in the works over the last few years, we are now starting to see that these two locations are transitioning from being affordable housings and mid-income housing locations to also now having attraction for a variety of different asset classes, including premium housing, retail, MSME offices, and so on. One reflection of this is the land pricing at which land is now transacting for industrial purpose. When we did our IPO 3 years ago, it was at about 2.5 crore rupees an acre, and now we did a transaction in last fiscal at over 6 crore rupees an acre. And at this stage, we are in advanced stages of a transaction which will be likely to be at over 10 crore rupees an acre. So that has been the trajectory of land pricing, and that too for industrial use. As these infrastructure projects complete, you will start seeing that Palava will be just 20 minutes drive from Airoli, which is the IT hub of the country, of the Mumbai region, and from 45 minutes today. And similarly, Upper Thane will become just 10 minutes from the Dombivli West railway station and a 15-minute drive into the heart of Thane Viviana Mall. Over the next few years, we'll see further infrastructure upgrades, including the opening of the Navi Mumbai airport, which will be only 35 to 40 minutes from Palava. And eventually, in the later part of this decade, the startup of the bullet train project, which will make a meaningful difference because after BKC, the first stop will be at Palava, getting people door to door from Palava to BKC in 15 to 20 minutes, which would be just fantastic. And if you look at the pricing at locations which are so much better connected to the two core job hubs, IT in Airoli and financial services in BKC, you can see how Palava is going to transition from being a location for mid-income housing to being a location for premium as well as mid-income housing, as well as other ancillary asset classes such as office, retail, and so on. I'm sure that some of you are aware that Jupiter Hospital, the listed hospital company, is building its largest hospital facility in the country at Palava on land which we have given or sold to them. So this is showing, the transition that is happening in Palava, and I expect over the next 5 years that the caterpillar will turn into a beautiful butterfly. And we expect significant ramp up in sales in Palava and Upper Thane, moving from about 2,200 crores for the year ending March 24 to going all the way up to about 8,000 crores per annum for the year ending March 31. And as a cumulative consequence of this continued trajectory, we expect that cumulative sales in Palava and Upper Thane over the next 3 decades would be in the range of about $175 billion US. And our EBITDA margins will also grow as the mix changes towards having a good reflection, a good presence of premium housing. All in all, we believe that as a company, our focus on consistent, which is predictable and profitable growth is a strategy which is going to deliver long-term results. We are lucky to have very long-term visibility through our land bank in various parts, but particularly in Palava and Upper Thane, which makes us the company with the largest, the real estate company with the largest and most productive land bank in the country. In addition to that, our ability to generate significant operating cash flow. We generated 57 billion of operating cash for fiscal 24 and are guiding to about 65 billion for fiscal 25. Gives us the ability, this operating cash flow combined with our low leverage gives us the ability to scale up whenever the opportunities present themselves. And at the same time, our development platform allows us to scale up in a profitable manner because we have the brand and the execution capability to take advantage of the market's demand and get both a pricing and volume benefit. All of this is being done by taking highest cognizance of maintaining very low leverage. We have learned our lessons from the past, and we will continue to make sure that our leverage remains well below the ceiling of 0.5 times of equity, net debt to equity, that we have set for ourselves. With this, I will now pause and request Mr. Tikam Jain, our CEO for the Pune business, who has admirably grown the Pune business over the last few years, to come in and give an overview of that part of our business. Thank you.
Thank you, Abhishek, and good afternoon to all. Let me give you some overview about the Pune development. So Pune is a very resilient and vibrant residential market which has seen significant growth on back of IT and manufacturing sectors, generating a lot of employment. It is also an education hub with presence of high quality talent, making it an attractive location for corporate to set up or expand their enterprise in the city. All these factors have led to become it 50 to 50,000 crores of residential real estate market, which is further expected to grow at the bare minimum 10 to 12% annually. Historically, it has been deeply fragmented market with hundreds of small players by locality. It is only last few years that branded players have started emerging and their shares have still small but not growing. Lodha achieved pre-sales of nearly 1,800 crore in this financial year of 24 in Pune. We enter any new city in 2 phases. First phase being the seed phase, in which we do fewer number of projects and focus on building our local team, understand the local market, approval processes, and want to build our brand. Once the brand and team are set, we expand rapidly. We have successfully implemented this strategy in Pune. We entered the city in the middle of last decade with our first project, Lodha Belmondo, at the outskirts of the city. The project was received very well. It helped us in establishing our brand in Pune and helped Pune residents to understand what Lodha stands for. Subsequently, post-COVID, we hit the expansion stage, and from 200 crore sales in financial year 21 from one project. Today we have achieved around 1800 crore from our 7 projects. We have not only created the record of significant scale-up in the city in a short period of time, but also established ourselves as a most premium brand in the city by selling the most expensive apartment in the city. This is really the true reflection of the strength of our brand. Customers are attracted to Lodha in Pune due to the brand and what we have delivered in Pune and Mumbai. The lifestyle upgrade that our homes provide in addition to reliable delivery promise are other reasons customers have trusted us. We hope to continue to deliver on the trust. Currently, we have a project in East, West, South and Central Pune where we are developing around 90 lakh square feet, including the planned launches. We are looking to add more projects in other parts of the city and have discussion in various stages. We are already in top 5 in the city from the pre-sales point of view, and it clearly shows that path towards becoming the number 1 developer in Pune in next 4 to 5 years. We aim to double our pre-sales in about 2 to 3 years and eventually have 12 to 15% market share by end of the decade. Our growth strategy is driven by going deep in the market that is present across the city. Just like MMR, in order to grow on sustainable basis, we have adopted our micro-market-based supermarket strategy, as Abhishek ji has spoken recently. Just like supermarket, in order to get the demand of location, we need to be present in the location or catchment area. Thus, in each micro-market of Pune, we will open our supermarket store equivalent, that is our project, in non-competing manner and get our deserved market share in the city. Pune organization has grown in size and capability over the past few years. Our Pune team has grown from 80 to just 450 people in the few years. We have built local capability across all the functions, including customer care, business development, design, construction, etc. At one point in time, we were adding one new person a day to team. We have been able to hire, train and retain top talent across the board and have emerged as a go-to organization to work for Pune as well. With this, I would stop here and hand it over to Abhishek ji and Sushil. Thank you.
Thank you, Tikam ji, for your detailed comments. I would only like to add and compliment the Lodha team in Pune on the fact that for the year ending March 24, we have achieved market share in Pune of about 5%, which is a major milestone in our journey to getting to about 15% market share by the end of the decade. And that shows that, as Mr. Jain mentioned, that our scale-up is now at a rapid mode, and we will expect to significantly grow in Pune in the years to come. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Lakhan from CLFA. Please go ahead.
Yeah, hi. Good afternoon. My first question is on your slide 6, which is the guidance for FY25. Now, when we look at the FY25 guidance of 0.5 times debt to equity cap, I'm just trying to understand the spend that we are targeting for next year, considering our current liquidity of about 3,000 crores odd from the fundraise, and OCF generation expectation of about 6,500 crores for the next year. So where do we see, firstly, 2 parts to my questions. Where do we see the debt levels in absolute terms by March 25? And secondly, how much do we plan to spend on business development in FY25?
Kunal, hi. The question that you've raised, obviously, as you know, we have a articulated debt ceiling of 0.5 times equity. And that is what we've stated as our guidance, that we will consistently remain below that. It doesn't mean that we will get up to that. It's a ceiling. It is not a target. In terms of where we expect debt to be at the end of the fiscal, obviously it will be dependent on growth opportunities, but given the cash on hand that we have, plus the operating cash flow of the business, we suspect it will be close to 5,000 crores of net debt at the end of the fiscal. And we expect to invest in the range of about 4,000 crores for new business development, plus continue to support the existing projects in terms of business development spend also.
Okay, so 4,000 crore will include both new as well as, supporting the existing.
No, the 3,500 to 4,000 crores will probably be purely new. The balance, incrementally, it will be existing, because if you look at the free cash, the operating cash flow of about 65 billion after interest and taxes, that number will be close to 50 billion. So that 50 billion plus the increase in debt of, let's say, 20 billion is, 70 billion. So we are looking at spending about half of that on new projects, and the balance to be available for other uses, including supporting existing projects.
So close to 70 billion will be the total spend on new business developments.
New business development, about 35 to 40 billion.
Okay, understood. And secondly, you said in your comments that the peak mix of JDAs in the pre-sales is now there. Almost 1/3 of our pre-sales. That's like the peak levels. So would it be safe to assume that going ahead, the business acquisition, the new acquisitions that you'll be doing would be more skewed towards own land versus JDAs?
I think, Kunal, your question probably has the answer also. As we've said, our target mix is 60% from owned land and 40% from JDAs. You know that we own a very large amount of owned land. Therefore, to maintain this 60-40 mix, it's likely that the incremental GDP addition will be perhaps 50% from JDAs and 50% from owned land.
Understood. And my last question is on a guidance for FY25 for pre-sales of 175 billion. How much would you expect from Pune? And since we don't have any Bangalore project, how should we look at Bangalore in FY25?
So between Bangalore and Pune, we would, conservatively be aiming to do about 40 billion. And, we'll see if we can further exceed that.
Understood. Thank you and all the best.
Thank you.
Thank you. Next question is from the line of Praveen Chaudhary from Morgan Stanley. Please go ahead.
Thank you. Thank you very much for the presentation, Abhishek. I have one or two questions. The first one is about margin. Would you be able to share the margin in Bangalore from the pre-sales of 12 billion? And the reason I'm asking this question is to understand in the early stage, maybe the margin is lower than the overall company level. So just to understand how much business development cost went in, and when would we get back to similar margin as we have, like 30-31%. The second question I had was, you mentioned that there's no speculative activity in most of the markets. So Mumbai and Pune sounds about right. But some of the data that we saw suggested that Bangalore property prices have gone up by a meaningful number. That definitely not 5.5%, again, based on some data that I saw. So would love to get your sense of 5.5 versus maybe 15% that we are seeing in Bangalore, and how are you seeing that affordability in Bangalore? And then I have one last question. Thank you so much.
Hi, and thank you for those questions. In terms of the margin in Bangalore, we were at about 28% for the sales that we've done so far. So it's slightly lower than our overall blend at 31%, but not significantly lower. And we expect, we do our underwriting in order to work from towards that blend of margin that we target. And therefore, obviously, while early stages, sometimes you will have gaps, especially in the early stages of any project, because the pricing at the early stage is lower and margin goes up as the project progresses. But generally, we try not to have too much significant deviation from the overall blend. Obviously, owned land and JDA projects have different margin profiles, but we try to maintain consistency across different cities, 200 basis points here or there, but broadly, we try to maintain consistency. In terms of, the price growth number of 5.5%, the way we measure price growth is for like projects. So the project ought to have existed in the last year as well as in this year for us to be able to do a price comparison on, what the price growth has been. For any project which is launched in this year, that becomes the starting point of the data from a measurement of price growth perspective. So in terms of your point that whether price growth in Bangalore has been stronger than 5.5%, I'm sure it is or has been. However, I do believe that Bangalore in general has good supply. Demand has been very solid. And at least in the sales that we've done in the first two projects, we've seen that most of the sales have happened to end users. People are buying for themselves. They're not buying, there's nobody's buying bulk units to trade later. So that's really, our sense of what happened in the Bangalore market. But obviously, there are only two projects in Bangalore. So, our understanding of the Bangalore market is definitely not as robust as some other people.
Very, very clear. Thank you, Abhishek. So one last question I had, if I may. Look, Palava land is clearly, very valuable as time progresses, and you have spent some time in explaining that. I just wanted to ask the near term. I understand the big picture, long-term potential, but in the near term, if I were to think about how much land you are planning to sell every year, or even contract sales from Palava, let's say FY25, FY26, would you have some guidance for us?
In terms of land sales, we're targeting, about $50 million, about 400 crores to 500 crores a year of money from land sales. Some years will be stronger and some years will be weaker. But that kind of is sort of the level at which we are sort of, transacting land. And as land values go up, the quantum of land that we will transact or sell will sort of, probably become lesser. In terms of, our sales expectation from Palava as well as in Upper Thane, the two large land holdings that we have, and we measure that data together. We did about 2,200 crores of pre-sales for fiscal 24. We definitely expect that to grow much faster than the rest of the company because the infrastructure related upgrades are now largely in place. So we would be looking for at least a 30% growth, if not more, in this fiscal. I don't have an outlook for fiscal 26, but I would not be surprised if the growth in fiscal 26 was also, around that kind of a level.
Okay, that's all I had. I just must congratulate you for a very good result. And most importantly, I find that your presentation in terms of growth, which is stable and sustainable rather than very high and then coming down, along with the ROE target, is very interesting and sounds very good to compounding companies, so to say. So thank you very much.
Thank you. Thank you for your feedback.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. Next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, thanks for the opportunity. First question is on, the capital raise that you have done and the deployment of it, and that leading to additional growth to the company. So you've guided for 20%, little over 20% kind of pre-sales growth. When do you think that, this capital raise can transpire into, 20% plus kind of growth, I mean, not marginally, but, a bigger delta in terms of growth? And do you see any upside risk in this guidance that you have given, because of the, new project additions that you will do throughout the year, and that can lead to additional, pre-sales like this?
Pritesh, hi, and thank you for your questions. You have been following our company for a few years, and I'm sure you know that we tend to be modest or conservative in how we look at the outlook, because things can often go in various directions which are unplanned or unknown, and we must rather focus on like we said earlier, predictable growth rather than lumpy or choppy growth. In terms of the deployment of the capital, ultimately the most important thing for us is to make sure that the capital generates ROE, and therefore this capital raise is not ROE dilutive. We expect that the capital will get fully deployed in the course of this current fiscal year, and definitely the ROE, and we expect the ROE levels to be back to our target levels of close to 20% by fiscal 26. There will be some dilution impact in fiscal 25 because obviously the capital takes some time to get diluted and start contributing to earnings. But by fiscal 26, we expect the ROE levels to be back to that close to 20% mark. I think in the early part of the capital deployment cycle, which has started now, you will start seeing benefit to profitability. So we have guided to 31% embedded EBITDA margin for fiscal 25 compared to 30% for fiscal 24, which itself is partly coming from the fact that we are able to use this capital to improve our profitability at the EBITDA level, and then further improve our profitability by the reduction in finance costs. Overall, meaning having a good impact on profitability. As the new projects get acquired, it will take about 9 to 12 months after acquisition for those projects to start getting to the launch phase, and therefore the impact on growth you will see more likely in fiscal 26, not in fiscal 25. But as I mentioned earlier, the way we think about it is to put this capital to productive use, which is making sure that our ROEs come back to where we want them to be, close to 20%. And at the same time, it is within our paradigm of predictable and profitable growth.
Sure. That's very helpful. And, in terms of the kind of deals that we are, getting to evaluate, has the characteristic change with deals largely coming from outright land rather than JDAs, or our strategy with this kind of capital that we have will tilt more towards outright, because that obviously helps us generate better margins and eventually better ROE. So what would be our focus that way?
So as I mentioned in response to an earlier point, we expect going forward our new GDV additions to be about 50% from JDAs and about equivalent amount from outright land, so that our overall mix of 60% of sales coming from outright and 40% from JDAs can be achieved. I do want to point out that the JDAs tend to have lower absolute profitability but quite high ROE, and the outright tend to have higher absolute profitability but lower ROE. So I just wanted to let you sort of highlight the fact that there is that inherent trade-off in the two models.
Sure. And the kind of deals that we are getting, are mix of both, JDAs as well as outright.
Yes, which is the reason why I'm saying it's likely to be close to that half and half mark. I think one has to appreciate the fact that JDAs and outright are both models which exist in the marketplace and have existed for a long period of time. It's not only a function of some particular post-COVID or post-ILNFS phenomena. JDAs will exist. They continue to exist because ultimately landowners have different financial profiles, and also, given the fact that most developers would like to be prudent in their balance sheet and maintain moderate levels of debt, the larger land pieces often are better monetized through JDA. So JDA opportunities will continue to remain available is our view.
Sure. And lastly, on Palava, do you see, FY25 as an inflection point with the kind of growth you are expecting in the residential segment there, or, there is more growth, which can be, captured, once everything in terms of infrastructure that we are talking about gets, developed, or this 25-30% kind of growth is the number that we are anyways eyeing for?
Pradesh, as we mentioned, we are looking at least, and I use the word at least 30% growth this fiscal. We hope that we can we can in fiscal 26 also maintain that level. I think the next 5 years are all going to be additive in terms of the growth, I would say enablers or drivers. And I think you really see Palava in full bloom, as I mentioned earlier, moving from a caterpillar to a butterfly over the next 5-year period. The Airoli Tunnel, the airport, the bullet train, the Metro 12 line, the Vasai-Alibag multimodal corridor, all of this, over the next 5 years is going to be very, very real. So I think it's 30% growth is probably just the start of this process, not the peak of this process.
Sure, that's very helpful. Thank you for the opportunity and all the best.
Thank you.
Thank you. Next question is from the line of Abhinav Sinha from Jefferies India. Please go ahead.
Hi, Abhishek. Thanks for the questions. Let's start with Palava itself. So, you started your comments by hinting at some premium products, or at least on the housing side. So when can we expect this launch, and what are the price points we are looking at?
Hi, Abhinav. So, we started doing premium product in Palava. It's about 8-10% of the sales mix in Palava and Upper Thane currently, where we are doing, standalone bungalows, and they are, totally, bungalows are total value, including land and construction costs, between 4 to 10 crores per unit already, and they have done very, very well, exceedingly well. The first multi-storied or apartment building, which is of the premium category, is getting launched this quarter. The price points are likely to be, close to 10,000 rupees a square feet. As you know, the average price point in Palava right now for the current product mix is more in the 6,500 rupees handle. So it's almost a 50% premium to that level. It'll be between 9,000 to 10,000 rupees a square foot to start off, and then go up. So it'll average about 10,000 rupees a square foot on saleable area. And that launch we expect this quarter.
Okay. So secondly, on slide 15, where you put out a pipeline for FY25, just wanted to check if South Central also has the Alibag project this year, or it's a FY26 project?
Yes, we expect South Central to have the Alibag project for this fiscal.
Okay. And that will be like a weekend destination sort of a project that you're creating?
I think, it is a very, very unique parcel of land. The scale of that parcel of land and the fact that the Alibag is seen as the Hamptons or the new equivalent of Hamptons for the Mumbai region, it's at a very, very high level of demand, and it's never really had the quality of development that we intend to do over there. So yes, Alibag connectivity is very decent right now. You can get there in about 20-30 minutes from South Mumbai, from a combination of taking the speedboat and then taking 5-10 minutes to get to the site. It takes about 5-7 minutes by car from the Alibag jetty to our site. So it's very, very accessible. You have a new bridge which is getting completed maybe in 2 or 3 years' time, which will also make the road connectivity, not through South Mumbai, but through other parts of Mumbai, very strong. So while it is clearly predominantly a second home or weekend destination, I know a lot of Mumbaikars who are now starting to think about living in Alibag for not just two nights a week, but more like 4 or 5 nights a week. And it really is dependent on whether the rest of the infrastructure is in place, healthcare, and so on. And we expect that this development of ours will fill in several of those infra gaps. So we don't only see it as a second home destination.
Great. Thanks and all the best.
Thank you.
Thank you. Next question is from the line of Siddharth Bhattacharya from Autumn Investment and Infrastructure Limited. Please go ahead.
Hello, am I audible?
Yes, hi. Go ahead, please.
Hi. So just one question from my end. So for the last few quarters, 6 or 7 quarters, we are seeing that the value share of ultra-luxury units and luxury units have gone up significantly in the overall mix. So let's say the top 7 cities. How do we see that as a trend and how does it affect us? If you could, give some perspective.
Yes, I think you're correct in saying that luxury sales have been quite strong over the last few quarters. I would also add to that affordable housing has been hit by the increase in interest rates, and we hope that the government's announcement in the budget to bring in a scheme to help first-time home buyers will come in after the elections and will help the first-time home buyers and affordable home buyers to get onto the housing ladder. Having said that, I think luxury housing is really a reflection of India's aspiration and India's wealth creation. And therefore, as long as India's job cycle and investment cycle continues to scale up, luxury housing will also do well. Luxury is something that people, use very loosely. But the real luxury which is doing well is truly, absolute grade A plus location, grade A plus product, and grade A plus developer, bringing in a complete grade A lifestyle. So I think one has to be careful while reading into what people call luxury, because everybody likes to call, a lot of things luxury.
Correct. Got that. Secondly, with the new airport sort of coming up, do you think that the development in the Konkan belt will be much faster compared to other areas of, the suburbs?
See, the Konkan area is not a suburb of Mumbai. It's a very, very large and significant, part of the state of Maharashtra, and has, many strengths. It also needs a lot of investment and a lot of infrastructure. I don't see that the airport, or for that matter, the MTHL immediately changes much, because it takes a lot to make a place attractive to live in. You need connectivity, which is starting to come in. You need airports, which is, again, it will be operational soon. You need social infrastructure, high quality education, high quality healthcare, good retail. In a place like Palava, it's taken a decade to put all of that together. So we do expect that, yes, there will be development in the area, but it is not going to, I would say, fundamentally change the dynamics of how the Mumbai region or the larger Mumbai region is operating.
Okay, got it. Thank you for answering my question.
Thank you. Next question is from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks. So my first question is, how are you looking at deployment of capital towards annuity assets, specifically commercial office space? And within that, how are you seeing office demand shaping up at Palava now that you have a large residential base there?
So we as a business are not focused on office development. Our focus is largely around housing. We do some strata office development, and our annuity strategy revolves around 3 pegs. One is our facilities management business along with its digital layer. Second is our warehousing and industrial parks business, and the third is very selective office. Specifically, we will do it in some places which have other strategic reasons, like Palava, and our retail portfolio, which is one mall and several other high street retail locations. So Palava, we expect office demand to remain to pick up. We now have HDFC Bank's training center completing soon. We have a pharma company, M-Cube, setting up its own R&D center. We have one office building which we are setting, which is now going to be ready this year, and we are going to start leasing it out. We already have presence of the back offices from various banks, including Axis and HDFC Bank. So yes, we have a variety of different mixes on the commercial office side, and we do expect that over the next 2-3 years, especially when you take into account as the bullet train connectivity to BGC becomes more real, this could become a preferred location for financial services back office, in addition to any other classes which are more driven by the existing talent or the fact that this is a great location for people to live and work close to each other.
Okay, understood. And secondly, how has been the progress on the Green Digital Infra JV with Ivanhoe and Bain? Any news in terms of acquiring land parcels there?
So the progress on the warehousing industrial platform with Bain and Ivanhoe Cambridge, we have 2 assets which are under development currently. One of those assets is actually about to become operational. Construction is almost complete. We are still in the process of acquiring land. The ramp up has been slower than what we would have liked it to be. We expect some land parcels to close this quarter, and then we'll take it from there. But right now we're only at 2 locations in that platform. We of course have a Morgan Stanley Park, which is a separate one.
2 locations would be, one would be Palava and the other would be?
Second is in Kurla.
Okay, yeah, perfect. Thanks. Those are my questions. All the best.
Thank you.
Ladies and gentlemen, that was the last question of the day. I now hand the conference over to Mr. Anand Kumar, Head Investor Relations of Macrotech Developers, for closing comments. Over to you, sir.
Thank you everyone for joining the call. Please feel free to connect in case you have any additional queries. Thank you.
Thank you. On behalf of Antique Stock Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.